Hello everyone, we're going to take a trip back in time to the 2019 market, and I've noticed some patterns, some things that have not happened since about 3 years ago, and they could be key indicators as to what's going to happen next in the crypto market. And as we go sideways, I want us to look into these. So the first thing we're going to do is have a little refresher on market structure. So what happens is a top is formed here. And then the price comes down and goes up and gives us a series of highs that keep going lower and lower and lower. And then it does the same thing with the lows where they keep going lower and lower. So this gives you an understanding of market structure. And you'll notice every time the price comes down, it kind of fails to break the next one. We had this wick go through, but that's not real confirmation. The price continues to trend down, gets weaker and weaker. And then sometimes you actually see a break continuing to the downside, and we enter the sideways consolidation again. During these moments, and we have similar stuff going on now that I'll get to, what you want to do is look out for the breaks, the shifts, the twists, because we haven't had any clean breaks this entire move down until here. So let's let this play out a little bit till we see a break, see price slowly coiling up there. There we go. We have our first break over here. Boom. This is the shift. Now, what could have happened is this could have turned into a wick and come straight back down. But as you'll see, that's not what happened. The structure completely shifted and price started to go up. In fact, from the bottom here, we had almost 80% price pump. And something really interesting I noticed as well. So 3 things so far. So we had a structure break over here. Then we had an 80% pump. And if we go back to the daily and we examine the top of the bull market here, you can see we did have a big amount of deviation. There's a lot of vague price data going up and down. And if we average it out, the main resistance isn't actually 20K at the top there, but the top is around 16K. This is the level that acted as resistance here and here. This is the level that had a slight bounce over here. And all of this is just price floating and came straight back down. So 16K becomes a very significant resistance that we want to pay attention to. And then after that, we've got the 20K, which is that all-time high euphoria break. Now, if we use this 16K level, you'll see something really interesting, that from this 16K level to the bottom of this move, we see, if we go a little bit further forward, a 236 retracement occurring at this structural level over here, which is $6,000. And we've gone a little too far forward, so let's cut that back. Here we can see a float right below this key 0.236 level. So these are 3 things that happened, with the last one being perhaps the most debatable. But the point is, structure break, really big, significant pump, 80%, almost 100, straight into key structural level and resistance. Because remember, this was a small structure break. This is a huge structure break. This is a resistance here that held an entire year. So reclaiming that is a huge move for the bears, not to mention it syncs up with the 0.236. And looking at the moving average, you can see that syncs up as well. So we've got a lot of factors syncing up and adding significance to this 6K level over here. And then we know the story. What happened afterwards is that we had a really big bull run triggered. Price got above this key shift level, went up for a bit, and you can see it interacting with these Fibonacci levels. Let's speed this up. And it did eventually actually come back down. It hit the 0.786 over there at the top and then came back down, and I'm pretty sure very soon, it will be about March of the next year, we saw a big dump down. So yeah, there you go, there's the dump. And even though we saw a decent structural shift over here, it took a really long time for it to become the full bull market again. I mean, don't get me wrong, there was plenty of money to be made in 2020, 2019. We had the DeFi boom, we had plenty of opportunities on altcoins to absolutely print, but it was really 2021 where the true bull market occurred, and that's this parabolic rise you see over here. As soon as the 16K level was claimed, it was over. A bit of resistance at the 20K, but that 16K level was the real level you needed to have been watching. Now, we've seen what happened there, and you guys know what happens till present day. What I want to show you next is quite similar situation happening right now. So here, 25K, I've been talking about this level a while. This is the key structural break. Then interestingly enough, you take a look over here, and what does that look like? Another 80% pump. And what do we have here? The 100-week moving average. And then what do we have here? A key support and structural level that lasted pretty much an entire year. So add that in as well. And then what do we have? Structure break, clean. Remember, put in the market structure, top, low, pretty much unbroken the entire way down. And we see this. You actually saw a mini break over here, then a really big break over here. So really important structure break, 80% pump, just like we saw before, and straight into, if we draw our Fibonacci levels, 236 resistance over here, which is slightly different because the previous one did have the 236 a bit higher. But the thing is, history never repeats, but it does rhyme, and you see a lot of similarities. And I'm seeing this looking extremely similar to what we saw back then, which means, let's clean up the chart. Let's take a central point over here of the structure shift, and then also take a look back here, the structure shift and what happened. Price went up, down, back to this level. So what if we see something like that happen here? Price goes up, hits 47.5k resistance. Everyone is extremely and overly euphoric. Everyone thinks this structural level here is claimed. We come back down, test it, everyone's happy, go back up, fake out, come down, big crash, and then off into the next bull market. That would be as close to a repeat as exactly what happened here as we saw before. So something to pay attention to, a similarity I noticed, and remember, I'm never going to trade as if this is exactly what's going to happen again. But what I am going to do, as everyone on crypto Twitter is getting extremely bullish, is take note of the fact that there are similarities and there are a lot of reasons to be bullish, but even if this was a key structural shift, just like we had before, we can still see us come back down to pretty much the bottom. Look, this was a black swan event, and I hate that word in crypto because black swan by definition means an unpredictable, very statistically unlikely event. And black swans happen in crypto all the time. FTX, Luna. They're not black swans, they're just things going extremely wrong in a very immature, poorly regulated industry. That's what we expect to happen. Like we will have more crashes. We will have more things go wrong. Exchanges explode. Regulations shut things down. New things coming out that make old things irrelevant. It's just part of what happens in this industry. So as we continue trading now, what are we looking at? Let's go to the 1 day. And we've got a tight sideways range here, which is causing fights all over the internet, at least in the crypto space. Very amusing to watch, but a complete waste of time to ever get involved in. We've got a nice range here. We can get rid of the moving averages because we don't need them here, except this one here, which is very nice for confirmation. And yeah, what we're seeing now is price bouncing between these two levels. You had a decent short opportunity recently. That was right over here at this level. And we can see if we take fibs here of this range, we're bouncing around the midpoint, which is about 27k over here. So lots of price bouncing, and the midpoint is holding nicely. Decent argument for the bulls, but the thing is, the longer we spend in this range, the less significant the price action in it becomes, because look, the sample size increases. When there's more data, individual pieces of data have less significance. Let me explain that a little bit. So if we go back here to this point in the chart, at this point, the bears are winning. The second you see the price bounce here, you need to be looking for a short up there, because following a candle like this, the recent price action is heavily in favor of the bears. Remember, always look at candles in context. When you see a candle this big in the context of lots of bullish candles, that is an argument heavily in favor of the bears. This makes a short play over here down to at least the bottom or even the midpoint extremely viable. But the more price action happens, now see, we came back down again. You could have gone for a long at the bottom of the range, especially when we saw this candle here. But again, risky play, and it depends on your system. But my point is, once the price action changes and the bulls seem to be winning again, sure, you could go for another short, but suddenly each individual candle matters less and less. When here, this one candle was like a significant percentage of the price action, now every new candle within the range is developing an already long story. It's like adding one chapter to a 9-chapter book and suddenly increase the book's size dramatically versus adding one chapter to a 100-chapter book. It's not as significant, it's not going to have as much impact. So it becomes harder and harder to trade this range the longer it goes on, and that's why I like to take more and more of a step back. This was a beautiful short opportunity over here. The second one was pretty decent too. This one I didn't love because, look, we bounced from the midpoint, go straight back into resistance after a test. I don't know if I want to be taking that short. It's possible, and it's a viable play depending on your system. Everything is. What I'm trying to do is explain my mindset and how I think about the charts, how I make these decisions so you can make your own systems. At the end of the day, you can't use my data. I was speaking to someone who tries to learn from my content the other day, and he told me something. He said, hey, every time I trade based on the fact that when there's a wedge, and let's just call this a wedge, right now, there is a 67% chance that it's going to break to the upside. Now, he didn't use this exact example. He was talking about something else, but let's pretend he was saying this. I then asked him, was that your data or did you read that somewhere? He told me he read it on Wikipedia. Now, that is never going to work. Do you really think you can just go and read something on Wikipedia and trade off of that? It simply does not work. The only data that matters is yours. If you want to trade a pattern or formation like this, and I don't really trade any sort of patterns, you need to build your own data set. You need to test your own data. You need to be journaling this, and you need to see if you have an edge in the market. Right now, as this range develops, my edge gets worse and worse. I do well when we're trending. Those are my favorite conditions. And I do some decent predictive trades at the start of a range formation. The later on we get into it, the less alpha there is, the more choppy it gets, the more people get bored, the more the easy money goes elsewhere where there's more volatility and you don't want to be touching it. So my plans are looking for the breakout play here and the breakdown play here. We can see a bit of support over here, and we could argue support over here, 25. We can see a bit of support at the 24.3K, and the main structural level is 25K over there. If we come back down to 25K, I will not only short on the way down, but I will look to buy at this level because I do not expect this key structural level to flip on the first test. It might, and I might lose some money, but that's the game of trading. The much nicer scenario, again, is to the upside. And if we zoom out back to the 1 day, you'll actually see more significance based on what we were talking about at the start of this video. This level here is extremely important. This is the equivalent of that 6K level back in the previous market. This is the point at which we flip the 100-week moving average, and that is a very big level to flip. If we get above that, start testing it again. I mean, look, that's what happened last time. We got above, tested it, deviated below, and then bounced off of it into Valhalla. Is there anything magical whatsoever about this level? No, it's just a moving average. It shows you the general trend and movement of the price. But combined with every other argument I presented here, we might be looking at something good. I'm focusing as much as I can on education. I want to teach you guys to trade. I'm not interested in doing influencer stuff to get views anymore. I just want to share alpha with real traders. If that's you and you want to actually trade the market, do well, make more money, then this content's going to be for you. And if you want to support it, you can use my Phemex link in the description below. And if you want to become a real trader, you can use my content online for free, or you can work with me and my team, and there's a link for that in the description below.